Hello everyone, good morning and welcome to today's morning report on Wednesday the 28th of April with me, Richard Perry, market analyst at Handtech Markets. The European trading session has got off to basically a very mixed start. There's nothing really doing in terms of equity market direction, and I think the traders are a little bit concerned as to whether they should take a position or not against the fact that you've got the FOMC tonight at 7 o'clock UK time in the evening, and the FOMC is certainly going to be the biggest driver of markets this week, I think. And they appear to be reluctant to take a position ahead of that. The fact is, though, that we're still seeing the dollar that's coming under pressure, and that has certainly dragged this dollar index lower. We've now got the dollar index that's fallen below this key March low of 96.17, and that sort of takes us to a 8 week low really on this dollar index. We're still trading in. I mean, I'll show you here that we are still trading in this big long uptrend on the dollar index, and it is still corrective within that move. And ultimately, I still see this as a decent. Potentially even a decent buying opportunity. I mean, a lot of the Forex pairs are going against the dollar at the moment, but I see that ultimately I think that the dollar strength will prevail in the end, and the chances are that in the coming months this move will be seen to be counter trend and seen to be as a buying opportunity. So it could well turn out that way, but I'll talk you through some of the Forex charts in a bit, but that is my opinion on the dollar index anyway. It's sort of coming back now towards the support of the last breakout high, which is at 95.48, so not too far away from that now. So that's sort of the Forex markets really. What we've got to look out for today is quite a lot of data actually in front of the FOMC. We've got throughout the morning you'll get the German CPI, the German inflation data, which will come through. And then you've got the US data that basically dominates the afternoon. You've got, first of all, GDP, the first or advanced reading of GDP for the States. Now this is a chart of the advanced GDP over the last few years. The advanced reading last month was 2.6. That ultimately got that ultimately got revised downwards to 2.2 in the final reading. But certainly what we're looking out for is 1% actually. Looking for a decline in the analysed growth in the States to 1% this quarter. So that wouldn't necessarily be too great going into the FOMC meeting, and I think that's probably one of the reasons why we've had the dollar that's come under pressure in recent in recent trading sessions in recent days, because the market has been sort of factoring in the fact that the FOMC is unlikely to be able to do a great deal in terms of pushing towards tightening today, because you've had the data that has come out pretty disappointingly recently, and that could sort of add to that move if that is the case today. And then part of that data, you've also got the core personal consumption expenditure, which does feed into the Fed's opinions and outlook on inflation. Actually, this is quite an important bit of data. This is the quarterly number, down to 1%. Actually, is the expectation this quarter. So it's sort of stabilising off. Certainly, last quarter was 1.1. So it looks to be just slightly dipping, but obviously reasonably stable, and that is something that the Fed will be looking at as well today. Then you've got the pending home sales at 3 o'clock. Now the pending home sales are expected to come in at 1%, so just dipping back from 3.1% last month. So that would be, I mean, that's a reasonable. Basically, you want to see the housing market in the States growing and increasing, so that would be sort of supportive of that, although it's not great growth coming through there. And then at 3:30 we have got the weekly oil stocks from the EIA, and that's forecast to come in at 2.3 million barrels, so it would suggest that we're continuing to just drop away, and that is interesting that in the last 2 or 3 weeks we've been markedly lower than much of the first few months of this year on the oil stocks in the US. Then you've got the Fed at 7 o'clock. Fed, as I said, I think it's gonna be fairly sort of middle of the road. Actually, you haven't got a press conference, you haven't got any staff projections either. So yeah, I think that it's going to be fairly middle of the road. It's not going to show too much of a change. Other than that, you've also got the RBNZ, Reserve Bank of New Zealand, and the Bank of Japan overnight as well. And neither banks are forecast to or expected to do anything in terms of their rates either. So a lot going on today. But that takes me now to my chart of the day, which is the Kiwi dollar. Now, the Kiwi dollar has been rising, but certainly the Aussie dollar yesterday had a sharp move up to the upside yesterday, significant gains, but the Kiwi didn't really or hasn't been able to break out. And interesting that it's 77.40 is the resistance that it keeps butting its head up against and failing to break out, and that's happened 4 times now in the past 2 weeks. 77.40, so that is an interesting level of resistance. It's sort of, I mean, you do have on this Kiwi sort of a recovery scenario, but I don't necessarily see it as a very strong recovery scenario. You look at the RSI here, again, it's failing to really break out too significantly, sort of confirm a recovery scenario. MACD lines, again, also not all that great. Stochastics have fallen away, and you could even argue that's a slight bearish divergence there on the 2 recent peaks. So the momentum isn't that great and not really supportive of a sustainable rally to the upside. I still think that this has the potential to be, as I do a lot of the Forex majors, I think it's going to be ultimately a bear market rally that will be sold into. This is the hourly chart, and I think what this shows you is that this obviously shows the 77.40 being the resistance. Comes in 3 or 4 times in the last 2 weeks, and you do have a slight bullish outlook to this chart, and certainly in the last few days the RSI has been finding support nicely above that 50 mark. If I get the crosshair going, you can see that nicely above 50, the RSI consistently. So that would suggest that near-term buying opportunities are on those dips. But what I would say is that you've had the MACD lines crossing over and falling away. Now, if those MACD lines start to sort of drop sort of below the recent lows, then you could well see that would be sort of dragging that RSI below 50 as well, and that could start to put pressure on this chart near term. But still, at the moment, I think you're still buying into the dips, and until you start to see the RSI on the hourly chart, probably, well, I mean, if you're going to go exact, you'd say below 47. If you start seeing that below 47, then perhaps that would be sort of starting to put pressure on that on this sort of near-term rally scenario. But I see this Kiwi dollar more as a near-term rally, and looking for just probably more medium-term selling pressure in due course, which is what I see across pretty much all the Forex majors. Anyway, I wish you good luck in your trading today on the Aussie dollar, and I will speak to you later. Thank you.